There is an IRS rule called the Rule of 55, and it lets someone retire early and pull from their 401k with zero penalty. Here is exactly how it works. Most people think retirement money is locked up until 59 and a half, but that is not the full story. The IRS built in a legal exception, and most people have never heard of it. Today, this video covers 7 things everyone needs to know before using it. Number 1. What is the Rule of 55 exactly? Here is the starting point. The IRS charges a 10% early withdrawal penalty on money taken out of a 401k or 403b before age 59 and a half. That penalty exists on top of regular income taxes, which means a person pulling money out early could lose a significant chunk of it to the government right away. But the Rule of 55 changes that. According to the IRS, if someone leaves their job for any reason during the calendar year they turn 55 or later, they can start taking withdrawals from that employer's 401k or 403b plan without paying that 10% early withdrawal penalty. It does not matter if they quit, got laid off, or chose to retire. The reason for leaving does not affect eligibility. What matters is the age and the timing. This is a big deal. Think about what that actually means. Someone who is burned out, ready to stop grinding, or simply wants to enjoy the years they still have their health, they are not necessarily stuck waiting until 59 and a half. They may be able to walk away at 55 and access their retirement savings immediately, penalty-free. Now, there is a critical word in there, penalty-free. That does not mean tax-free. The money pulled out still counts as regular income and will be taxed at whatever income tax rate applies that year. But the extra 10% penalty, gone. And for someone with a large 401k, that 10% can represent tens of thousands of dollars, so avoiding it is a serious financial advantage. The Rule of 55 applies to 401k and 403b plans. A 403b is the retirement plan used by many teachers, nonprofit workers, and healthcare employees. So this rule covers a wide range of working people, not just corporate employees. Number 2, the one mistake that kills this benefit completely. Here is where a lot of people accidentally destroy this benefit without even realizing it, and this is so important it needs to be covered right now. The Rule of 55 only applies to the 401k or 403b from the most recent employer, the one someone was actively contributing to when they left their job. That might sound straightforward, but here is where the mistake happens. Many people, when they leave a job, roll their 401k into an IRA. It sounds like the smart move. Consolidate everything in one place, get more investment options, simplify the accounts. Financial advisors recommend this all the time. But here is what often goes unsaid. The moment that 401k gets rolled into an IRA, the Rule of 55 disappears. IRAs have different rules. There is no Rule of 55 for IRA accounts. To access IRA money before 59 and a half without a penalty, a person would have to use a completely different strategy, and it is much more complicated and rigid. So the sequence matters enormously. If someone is planning to retire at 55 or 56 and needs access to their 401k funds, they need to leave that money sitting in the employer's plan, not roll it into an IRA. Once it moves to an IRA, it is locked up under a different set of rules. There is also a second version of this mistake. Some people have old 401k accounts from previous jobs. Those old accounts do not qualify for the Rule of 55, even if the person is now 55 or older. The rule only covers the plan from the employer they are leaving at the time they turn 55 or older. But here is something useful and something worth discussing with a financial advisor. Some employer plans allow people to roll old 401k accounts from previous employers into their current employer's plan. If that is done before leaving the job, all of that money could potentially come under the Rule of 55 umbrella. The key word is before. This consolidation must happen while still employed. Once someone separates, it is too late. So the takeaway here is simple but critical. Do not automatically roll the 401k into an IRA when retiring at 55. Think through the plan first. Number 3, the calendar year rule and why it matters more than a birthday. Here is something that surprises a lot of people about this rule. The IRS does not care about someone's exact birthday. What matters is the calendar year in which they turn 55. Here is what that means in practice. Say someone's 55th birthday is in December 2025, but they decide to leave their job in February 2025, 10 months before their birthday. Under the rule of 55, they can still qualify because they are leaving their job in the same calendar year they turn 55. That is a genuinely useful flexibility. It means someone does not have to time their retirement down to the exact day they blow out 55 candles. They can leave earlier in the year and still be covered. But the opposite is also true. And this is where people get tripped up. If someone left their job at age 53, they cannot come back later at 55 and start using the rule of 55 on that old plan. The separation from service has to happen in the year they turn 55 or later. Leaving early and waiting does not work. Similarly, if someone turns 55 in one year but does not actually leave their job until the following year, they still qualify because they are now older than 55 when they separate. The minimum is 55, not an exact cutoff. This calendar year flexibility gives people a bit of planning room. For example, someone who knows they want to retire in their mid-50s might choose to time their departure strategically, maybe leaving in January of the year they turn 55 rather than waiting until after their birthday, and still qualify. Number 4. The early bonus for public safety workers. Now here is one of the most overlooked parts of this entire rule, and it applies to a very specific group of people who absolutely deserve to know about it. If someone works in a qualified public safety role and retires from that job, they do not have to wait until 55. According to the IRS, they can start taking penalty-free withdrawals in the calendar year they turn 50. Who qualifies as a public safety employee under this rule? The IRS includes police officers, firefighters, EMTs, air traffic controllers, federal law enforcement officers, corrections officers, customs and border protection officers, and certain other government emergency personnel. That is 5 full years earlier than the standard rule of 55. For someone in a physically demanding career who has spent decades on the job, those 5 extra years of penalty-free access could be a life-changing difference. It is also worth noting that this exception applies to governmental plans, meaning the plan has to be sponsored by a government entity. Private sector workers in similar fields should check carefully with their plan administrator because the specific rules around who qualifies can be nuanced. If there is any chance this applies to someone's situation, the right move is to verify it directly with the HR or benefits department and ideally confirm it with a tax professional. This is not the kind of detail to assume, but it is absolutely worth finding out. Number 5. The tax reality. What penalty-free actually means. This is the part that gets glossed over the most, and it needs to be said clearly. The rule of 55 eliminates the penalty, not the taxes. Every dollar withdrawn from a traditional 401k under the rule of 55 is still taxable as ordinary income. The IRS will typically withhold 20% automatically when the distribution is made, depending on someone's total income for the year, including any other income from part-time work, a spouse's earnings, or other sources, more or less may be owed when taxes are filed. This is where smart planning can make a real difference. For example, if someone retires in the middle of the year, they may have already earned a decent amount of income from working in the months before retirement. Pulling a large 401k withdrawal in that same year might push them into a higher tax bracket. Some retirees choose to wait until the following January to start withdrawals, when their annual income drops because they are no longer working, so the tax hit is lower. There is also the question of required minimum distributions, often called RMDs. Once someone hits a certain age, currently 73 under current law as of the time of this video, though always verify with a tax professional as tax law changes, the IRS requires them to start taking money out of traditional 401k and IRA accounts whether they want to or not. For people with large balances, those forced withdrawals can push them into higher tax brackets later in life. Using the rule of 55 to draw down the balance a bit early while income is lower can actually be a smart long-term tax move for some people. Fewer dollars sitting in the account later means smaller RMDs later. It is not the right move for everyone, but it is a strategy worth thinking about. The bottom line, factor in taxes when building out a retirement income plan. The 10% penalty going away is a big win, but the income tax side of the equation still needs to be managed carefully. Number 6. Can someone go back to work and keep withdrawing? This is a question that comes up a lot, and the answer is yes. Once withdrawals start under the Rule of 55, going back to work does not stop them. Someone can retire, start taking distributions from their qualifying 401k, and then later decide to take a part-time job, start a small business, or return to some kind of work. Those withdrawals from the old employer's plan keep going. The key thing to understand is that the Rule of 55 only applies to that specific plan from the employer they separated from at age 55. If they start a new job and begin contributing to a new employer's retirement plan, the old plan still follows the Rule of 55 rules. The new plan would be separate. This is actually great news for people who want to semi-retire, meaning they step away from a demanding full-time career, start drawing from their 401k to cover some of their expenses, and then pick up lighter or more flexible work to supplement that income. The Rule of 55 can be a bridge that makes that kind of gradual transition financially possible. Number 7. What about the rest of the retirement picture? The Rule of 55 is a powerful tool, but it exists in a bigger picture, and there are a few important things anyone considering early retirement at 55 needs to think through carefully. First, Social Security. The earliest someone can claim Social Security retirement benefits is age 62. Retiring at 55 means there is at least a 7-year gap before Social Security is even an option. That gap has to be covered by something, whether that is the 401k, savings, a pension, part-time income, or some combination. And claiming Social Security early at 62 comes with permanently reduced monthly payments. The full retirement age for most people currently falls between 66 and 67, and waiting until 70 results in the highest possible benefit. This is a big financial decision that goes well beyond the Rule of 55. Second, health insurance. Medicare does not kick in until age 65. Retiring at 55 means 10 years without employer-sponsored health coverage. That is a real and often significant expense. Options include COBRA continuation coverage from the former employer, usually very expensive, coverage through a spouse's plan, purchasing a plan through the health insurance marketplace, or other options. This cost needs to be factored into any early retirement budget. Third, not all 401k plans actually allow partial withdrawals once someone leaves. Some plans require the entire balance to be taken out at once, which could create a serious tax problem. Before making any retirement decisions, it is essential to contact the plan administrator and ask exactly what the withdrawal options are. Never assume the plan allows for flexible distributions. Fourth, every situation is different. The Rule of 55 is a legitimate legal IRS provision, but using it correctly and in a way that makes sense for someone's specific financial picture really does benefit from the guidance of a qualified financial advisor or tax professional. The rules around taxes, RMDs, Social Security timing, and withdrawal strategies are complicated, and the right choices depend heavily on individual circumstances. Here is the bottom line. And this is the part that matters most. The system is set up in a way where most people never hear about the Rule of 55. They spend years grinding away at a job, assuming the retirement money is off limits until 59 and a half, and they delay a retirement they could have started years earlier. The 10% penalty feels like a wall, but for people who leave their employer at 55 or older, that wall can come down. Legally, permanently, and without tricks. The Rule of 55 is not magic. It does not eliminate taxes. It does not work with IRAs. It does not apply to old employer plans that have already been rolled over. But for someone who understands the rules, plans ahead, and keeps their money in the right account, it is a real and meaningful path to an earlier retirement. The question is not whether the rule exists. It does. The question is whether someone is going to learn about it in time to actually use it, or find out about it after they have already rolled everything into an IRA and lost the opportunity. The Rule of 55 is real, It is legal, and most people find out about it too late, after they have already rolled their 401k into an IRA and lost the benefit forever. Do not let that happen. The retirement that has been earned is closer than it looks. If this was helpful, subscribe so the next video does not get missed.